Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex, where I focus on interesting ideas in the world of finance, explain, for example, how various financial products work, how various financial institutions work, and today I'm going to look at a particular institution which is very much an important part of the world's financial landscape, and these are clearing houses, or sometimes called central counterparties, CCPs. So in this video I want to walk through how a clearing house works, and this would involve, for example, looking at how the clearing house applies margining to open positions, say in both the futures and options market, or increasingly nowadays in the derivatives market such as swaps as well. And I'll look at some of the mechanics of these particular institutions. Let's start by looking at two major clearing operations. The first one on the left here is CME Clearing, which is part of CME Group, the CME Group of companies. Now, the CME Group, which is the largest derivatives marketplace in the world, and they trade various derivatives such as futures, options, and so on. CME Clearing acts as the central counterparty for 20 million daily transactions conducted on the CME's exchange or trading platform. The clearing operation acts as the buyer for every seller and the seller for every buyer. Just to quote from the CME Group itself, we enable clients to trade futures, options, cash, and over-the-counter markets, optimize portfolios, and analyze data, empowering market participants worldwide to efficiently manage risk and capture opportunities. Over on the right-hand side, I want to take another clearing house. Now, this is different and distinct from CME Group because this is not essentially based on a trading platform per se, such as a futures market, which is very much a part of the CME Group's history. This is known as LCH, or London Clearing House. It was previously known as LCH ClearNet, and it is a leading global clearinghouse headquartered in London. They also have an office in Paris that provides central counterparty or CCP services for various asset classes. Acting as a financial market infrastructure, it clears trades for major international exchanges and OTC markets. And in fact, that really is the focus of LCH. It is by far the largest single clearing operation, say, for example, for swaps and other over-the-counter derivatives. This illustrates the CME clearing operation. You can see over here is the clearing house. It's involved in all these activities: post-trade processing, mark-to-market, which of course is a fundamental part of what clearing houses do. They take all open trades, all open positions, whether that say be in the futures market or whether it be in the swap market. They look at the exposure of each of the counterparties. They mark the positions to the market, and to the extent, let's say, that the position, the trading position, has moved against the particular trader, then full 100% collateralization is required. This is what is known as the daily mark-to-market regime. There are issues around margining. There are quite complex issues to do with cross-margining. Then there are issues around settlement, whether, for example, one might settle a futures contract by actual delivery of the underlying, let's say, commodity, maybe crude oil or even US Treasury bonds, or whether the settlement will be in the form of a cash settlement. This describes the actual process whereby, for example, the clearinghouse conducts netting operations, so it nets out the exposure between two different counterparties or the same counterparties that might have occurred during the course of a day. They can net out the exposures based on their trading of, say, similar instruments and so on. Now, the CME platform itself operates primarily today as an electronic platform. The days of what were known as open outcry have come to an end. There is still a certain amount of trading on the floor of the exchange in Chicago, but most of it happens on the Globex electronic platform. There are clearing member firms that have direct access into the CME Clearing platform, as it were. These are companies that had to meet quite stringent, capital requirements to make sure they're adequately capitalized, etc. And many of these firms conduct huge amounts of trading on a proprietary basis for their own account, as it were, but many of them are also acting effectively as prime brokers, allowing their customers, which might be smaller funds, smaller hedge funds and so on, to essentially piggyback on the access that the clearing member firms have directly into the CME Clearing platform. Now, LCH doesn't really underpin an exchange in the way that the CME Clearing operation does. It actually is primarily involved in clearing swaps. So let's have a quick look at some statistics here. This comes from the Bank for International Settlement. It is up to the end of June of 2024. That is the most up-to-date information available. And what I can say briefly is that this deals essentially with the swap market. And as can be seen here, there is somewhere in excess of $700 trillion worth of notional in outstanding swaps on an over-the-counter basis. The largest part of this column, as you can see, is for interest rate swaps, and you can see smaller amounts for FX, equity, credit default swaps, and so on. The notional is never actually really at risk. It is simply the amount which determines the size of the cash flows that are going to be swapped by the two parties to the deal. The gross market value, which essentially would be the cost of replacing all of these outstanding swaps at their prevailing mark-to-market values, is somewhere here around $16-17 trillion. And on the right panel, we can see what might in some ways be considered to be the risk or credit risk, if you like, within the swap market. But even this overstates it because of the degree of collateralization which is involved in, say, mark to market. And this number down here is fairly, say, close to $3 trillion. Now, this slide illustrates just really the importance of the CCP clearing model in today's financial landscape. If we look here, for example, the blue line running across here, if we go back to before 2008, the CCPs, clearinghouses, did not clear any interest rate derivatives or swaps. Since then, as a result of legislation, big changes in the regulatory world and so on, CCPs now, and it would be primarily LCH, as I mentioned, clear approximately 80% of all interest rate swaps. I believe the number is that 90% of that, 80% as it were, is in fact cleared by LCH, the London Clearing House. And not quite to the same extent, but once again, starting back here, the regulators and so on insisted that CCPs become far more involved in clearing credit default swaps, and they clear about 70% of those. And again, most of that goes through LCH. When a clearinghouse does mark a position, open position to the market, there is a requirement that all traders, all member firms or individual traders and so on, must post initial margin. Now, this is essentially a good faith deposit or collateral which is posted by the trading firm, the clearing member maybe, or an individual which typically would go through a broker. This is an amount that is set aside to essentially collateralize or cover what might be lost on the first day of trading. That amount in monetary terms is determined by the clearinghouses using an algorithm known as the SPAN algorithm, and the CME group actually developed this many years ago, and they've licensed it out to all the other exchanges and clearing houses around the world. So the algorithm is in the public domain, and it is possible obviously to have a look at that and determine what the actual margin will be. The amount of the margin, in monetary terms, will depend very much on the recent volatility of whatever the underlying is. So for example, if you're looking at the initial margin in the crude oil market, you would need to consider maybe the most recent 3-6 months volatility in the price of crude oil. And then, as will be seen when I come on to explain it in a moment, what happens on a day-to-day basis, the clearing house monitors all open positions, all open trading positions, marks them to the market, essentially applies the closing price for that day for whatever the underlying is, determines whether or not the trader is in a negative position. In other words, the trader's gone against the trader, and then there would be a requirement to the trader, which would go via, say, the clearing member firms or the brokerage houses, what have you, whereby the trader must then fully collateralize the exposure on a day-to-day basis. And as can be seen, what we are looking at is, in this case, how margin works with regard to a West Texas Intermediate crude oil futures contract. Now, this is a contract that trades essentially on the NYMEX, which is now owned by CME, and thereby it would be primarily found on the Globex platform, the electronic platform. There is in fact another very important crude oil contract which trades on another exchange, which is the ICE exchange, and that would then be cleared by ICE clearing. But I'm going to focus on the WTI contract, although both the WTI and the Brent contract, which is the ICE contract, follow exactly the same logic. So let me then turn now to Excel, and I will work my way through what's on the screen, and I can then explain the logic behind the margining approach, the day-to-day mark-to-market. So let me now work through what we can see on the screen, which shows how margin works, in this case for a WTI crude oil futures contract. This contract trades on the Globex platform, and I'm going to take really the perspective of a small retail trader, let's say. Now, the contract size is 1,000 barrels of this particular type of crude, WTI, which is actually technically specified. And the example's simply going to focus on one contract, and this is a long position. And let's say that the price of the futures at the beginning of this trade is $70 per barrel. So given that there are 1,000 barrels, the notional size of the contract is $70,000. So one could argue that effectively the trader controls, in inverted commas, $70,000 worth of WTI. This is actually not far from where the actual values are when this is being recorded at the beginning of August 2025. Now, as it turns out, these numbers are fairly close to what the current situation would be. So the initial margin, what is then required to open this position, is $6,050. And this is calculated, as I indicated previously, by using the span algorithm. What actually happens is the maintenance margin is calculated based on recent volatility of WTI, and then the initial margin is a 10% uplift from that number there, the 5,500. So, as I have previously mentioned, the trader, in this case working through a broker, would have to fund the margin account with that initial margin amount there, 6,050. So let us work our way down through this series of hypothetical days of trading for this contract. So at the beginning, we can see the price is obviously 70. And at the beginning, obviously, there are no gains, losses, and what have you. There's the margin account balance of 6,050. Now, this would actually be the same day. This would be the end of the first day. This, let's say, position was opened earlier on in the day, and we're now looking at the closing price on the same day, at the end of day one as it were, and let us suppose this has gone to $68.50. So there is now a mark-to-market loss, currently unrealized, of $1,500. We deduct that from the margin account balance, which brings it down to $45.50. That brings that number below the maintenance margin. That then triggers a margin call, which would then be administered, say, in this case, by the brokerage, and they would transfer $1,500 from a funding account, and this would then top up the margin account, bringing it back to the initial margin. Now, on the second day, we can see another drop in the price, 67, bringing about another $1,500 mark-to-market loss, not yet realized, but a mark-to-market loss, triggering another margin call, which would then need to be filled, which would then need to be topped up back to the 6,050. We can see a series of prices here. Some days the price goes up from the previous day, sometimes below. Here on day 6, we have the worst, most negative position for the trader, where the price has actually gone to $66 a barrel. That would then have led ultimately, on a cumulative gain or loss basis, to $4,000 unrealized loss. This would have been what we could call the maximum drawdown number, which you can see here. So there's again a margin call following the same logic as before. Here, after 10 days, let us suppose, finally the price has actually risen above the entry price of $70. It is at $70.60. And let's suppose that this is when the trader decides to exit the position. At this point, this $600 gain is then realized. All of these are simply mark-to-market ups and downs, but at this point, this is now effectively a realized, in this case, $600 gain. And what happens at this point is that all the funding that went into this margin account is released. There's no further trading on this particular position, so the brokerage can then release all of the margin account funding. Now you can notice here that I did not remove from the margin account any excess. It needs to be above the maintenance margin, and as I've explained, based on margin calls, it needs to be topped up. Theoretically, one could remove or withdraw from the margin account, but since it is possible to earn interest both on that margin account balance and also the funding account, one could, for example, be holding treasury bills to fund those accounts. It doesn't seem to be, unless the numbers get really rather large, it doesn't seem to be worthwhile to move money back and forth between the margin account and the funding account. Over here we can see the total margin cash that's called, in other words, the topping up of the margin account from the funding account, and that actually reached its maximum here on the same day as the maximum drawdown, and at that point $10,050 had been required to maintain the margin account. There's the $10,050 there. So I hope very much that you found that discussion to have been interesting and useful. And could I encourage you then to subscribe to my YouTube channel, the Corcoran Codex here. And as you can see, what I focus on are critical ideas episodes in the world of global finance. There is no obligation or charge to subscribe to the channel. It does then enable you to be notified of new material that I'm adding on a regular basis to my channel. And I'd also thank you then very much for watching.